When a brand launches a product, they will look for product differentiation, whether it is consistent with the brand image, the demography who are going to use it, the product experience, the end user process of engaging with the product. But would a product engineer ever conceive that how will a pawnbroker treat this product and hence what should my pricing be? Never. But in the world of the markets of equity, bonds, commodities, you would notice that there is another layer that is hidden which yields a lot of power which does not meet the common man's eye. And that is a pawn shop that is hidden from most of us. Welcome to the world of repo markets.
The repo market isn't a branded exchange like the New York Stock Exchange or the National Stock Exchange. There is no ticker board, no flashing lights. It's more like a network, a web of financial institutions, banks and NBFCs that quietly act like the pawn shops of the financial world. Instead of watches or jewelry, they deal in digital assets, things that can be valued in real time. Treasury bills, government bonds, even warehouse receipts of gold and other commodities. Here's how it works. You pledge an asset that has value and you get cash in return instantaneously. Digitally, you sign a short-term contract, usually overnight or for a few days, promising to buy back your asset later at a slightly higher price. That extra amount is the interest. It's quick, efficient, and keeps the entire financial system liquid. Let's take a simple example to understand how it plays out in practice. Repurchase or repo, this is the basic transaction. You pledge your asset, say a gold or bond, to borrow a cash for the short term. You promise to buy it back later at a slightly higher price. That is the interest. This is a secured short-term loan, like a pawn shop with a receipt. Now, what is rehypothecation? This happens after the initial repo deal. The lender, the one who received your collateral, now uses your pledged asset again to borrow their own cash somewhere else in some other pawn shop. In other words, the collateral keeps getting repledged, creating a chain of funding. Pawn shop A to pawn shop B, pawn shop B to pawn shop C, etc., all backed by the same original asset, and hence the name rehypothecation. Rehypothecation means reusing the same pledged asset to raise more money. It boosts liquidity but also builds invisible leverage. If repo markets didn't exist, it would be like saying home loans shouldn't exist. The truth is, this is how trade was made and always worked. Since ancient times, merchants have pledged gold, land, spices, or ships as a collateral to raise funds for their next voyage or project. This wasn't called repo back then. They just understood that credit backed by real assets kept commerce alive. The modern repo markets does the same thing. Only thing, instead of ships or spices, the collateral is digital. Gold receipts, treasury bills, ETFs, stock index. It's the same ancient engine of trust and liquidity, just running at the speed of computers instead of caravans. The pawn shop down the street values your gold or watch once. Then you pledge it, and that price stays fixed until you buy it back. But in the repo market, the collateral isn't physical. It's digital and live. Its value changes every second based on real-time market prices of gold bonds or ETFs or index. That means if prices fall even slightly, the lender instantly sees the collateral has weakened and issues a margin call, asking for more cash or more collateral. So unlike the neighborhood pawn shop, any price movement in the repo market can trigger immediate reactions in the actual markets, because those same assets are traded in both places. In other words, a tiny ripple in the opaque repo world can become a wave in the stock, bond, commodity world in real time, and that is in front of the eyes of everyone. In the repo market, the same underlying asset, say a bond or a gold receipt, might be used by several financial institutions to raise short-term cash. Now imagine that underlying asset suddenly loses value. In an instant, every institution that used it as a collateral receives a margin call, a demand to top up cash or provide more collateral to cover the drop, which is fair. Most of them, in general, won't have enough free cash lying around. So what do? They start selling whatever they can sell fastest. Their most liquid assets, maybe blue chip stocks or gold ETFs, government bonds or oil or any commodity. But here's the catch. Those liquid assets might also be serving as collateral somewhere else in the repo chain. So when their prices fall, more margin calls are triggered, forcing more sales, when pushing prices down even further of other types of assets. A small devaluation in one corner of the system can turn into a market-wide chain reaction, where everyone is selling at once, not because they want to, but because they have to raise cash. In a leveraged world, one margin call can trigger 1,000. That's the hidden domino effect of the repo market. Hence, in today's world, no asset is truly isolated from the financial domino. Even a house, the most tangible, illiquid thing that one can own, often sits behind a digital home loan that can be securitized, and those securities are traded. So, when funding tightens somewhere in the global web, it can touch everything, from gold to government bonds, from tech stocks to the roof over our head. Hence, as a retail investor, we can't escape being a part of the domino, but we can certainly be prepared for it. This means building liquidity, avoiding panic, and treating every crash not as a catastrophe. It is not that the fundamental value of these underlying assets have been deteriorated. It is because of the need of the hour of repo market margin calls. This causes the inevitable reset, giving retail investors like us a chance to buy strength as weakness.
In the next section, let us look at how repo markets have created market falls and what are the lessons that we can learn from it. Stay tuned.